A very good evening to everyone. I'm Ghazal Jain, Associate Fund Manager, Alternative Investments, and I welcome you to this exclusive webinar, 2021 Boom or Bust. The India growth story looks promising, with predictions of our country advancing to become the fastest developing economy in Asia in 2021. We want you to have all the information you need to make sound investment decisions and leverage this opportunity. And so we have with us today Mr. Ajit Dayal, founder, Quantum Advisors, and Mr. Chirag Mehta, Senior Fund Manager, Alternative Investments. And they will be talking to us about what 2021 has in store from a macroeconomic perspective, which way are the markets headed, and how will 2021 turn out to be for equities, fixed income, and gold. We have a dedicated time post the presentation for taking live questions, so we encourage you to send across your questions for Ajit and Chirag on the chat. Now, without further ado, let's get started. So over to you, Ajit and Chirag.
Good evening, everyone. Welcome to, I guess, the last webinar for Quantum before the budget, which is coming up on Monday, eagerly anticipated budget. So maybe I'll start off with a couple of introductions on kind of the background before Chirag takes over on specific asset classes. So I think one of the most important things when we move to the next slide will be that this COVID, which has been occupying our lives and our minds since, March of last year, February, March of last year, has really upset a lot of people's lives, plans, everything that one can think of. So the personal tragedies, the work difficulties, including for governments, for economies. And I think one of the most startling things that I can think of in terms of what was expected to happen at the start of COVID, there was a lot of discussion, including my own fears, that COVID would spread widely across India. No one expected it to go on this long. I think people figured by June, July, August, when you had the first set of lockdowns, COVID would disappear and we'd be back to some kind of normal sooner rather than later. That was the optimistic view and the wrong view. But there was also a very pessimistic view that India would see 400, 300, 200 million, you name it, cases. And there would be, a very difficult time in terms of deaths and fatalities and casualties, etc., from COVID. And as time has marched on, what we've seen, at least what I've witnessed, and I've actually been traveling in Europe and I've been in India during the lockdown, and we've seen that the numbers in Europe and the US have been surging. And India is probably the only country that I know of where after removing the lockdowns and people are, kind of back to some kind of normal life, COVID has not surged again. There is no second wave. We haven't seen it so far. We thought, okay, maybe during the Christmas and the New Year break, because even Diwali people were muted, but maybe over Christmas and New Year, there would be a surge after that. Well, we're like a month away, effectively after New Year's Eve, and we're 5 weeks, 6 weeks beyond Christmas, and we haven't seen the second surge at all. And, we all know that we can go out, we're still being careful, but we can go out. Whereas in Europe, everything is completely locked down. Australia has already announced that they will have no travel for the year 2021. Canada is pretty much locking down the country for 2021. So there's a lot of global dislocation still. And India is this shining star where COVID has not been a problem. So maybe on the next slide, we can just look at the India specific numbers. Like we said, it started in March, and of course the April data showed that the cumulative cases just shy of 34,000, and they gallop over the next 7-8 months. And of course, sadly, the deaths cumulative also gallop along with that. But the overall death rate in India at 1.4%, 1.3% is substantially lower than the global averages of 3% or so. And we all have been reading about the vaccines that have been approved around the world. India, of course, is supplying vaccines not only for local Indians, but also using vaccine diplomacy in some sense and giving it to other countries that are, that don't have access to vaccines. So from Africa to Mauritius to Bangladesh, etc., which is one India, a lot of, brownie points in the world. And, everything's looking fantastic. And even from the perspective of where we were, the migrant problem, the March lockdown, we saw these horrible images of, migrant labor leaving big cities, moving to rural India on foot, on bicycle, etc. I mean, a lot of that has calmed down, and the government stepped in. The government distributed food, has given ration. So there's a lot of work that has been done by the government, after an initial sort of freeze, if you will, which has helped. And then the next slide indicates that what does all this mean for corporate India? What does this all mean for industry? So in the next slide, we're actually seeing the data points where sales from a consumption pattern, the pent-up demand, we've seen that being unleashed, whether it's for two-wheelers or cars or anything. So we're seeing that demand pick up again. And so the Indian consumer still has the willingness to consume and the desire and the ability to consume. On the production side, moving to the next slide, if you think about where things were just after COVID, I mean, we had an economy that collapsed by 25% in terms of GDP, the sharpest in India's history and one of the worst recorded falls in GDP. So you saw that, very dramatic collapse, and everything now is recovered, whether it's cement production, whether it's electricity generation, everything, cargo activity, again, turning to the next slide, as one more number, as one more chart comes up. So everything has picked up in terms of economic activity, as this slide and the next slide also indicates. And what we've seen from all this activity is, of course, stock markets have gone up. Companies, in fact, are actually showing better profits because they've curtailed costs and they've had sales, and raw material pricing has not been risen so far. So things are looking good. Of course, there are certain, parts that are still red, which have to be recovered still. But where we stand today, the pluses for India, as we indicated, economic activities picked up very sharply, which has been fantastic. Interest rates have been collapsing in India and the world. And, one of my pet ideas has been, as those who've read The Honest Truth know, that rather than creating a bad bank, which everyone seems to be focused on, the government should actually create a good bank. And the good bank should take advantage of interest rates around the world and low interest rates. It should borrow up to $100 billion, put it in this good bank, and let this good bank fund housing finance in India for those who want to buy homes. That's about the safest lending in India that you can get. And by the time, as you've seen in the state of Maharashtra, when the Maharashtra government reduced stamp duty taxation, you saw the jump, you saw the surge in total transactions. If you did that nationwide, if every state was to suspend or reduce their stamp duty, there could be a catalyst for people to buy real estate. And when people buy real estate, they buy goods with it. You buy furniture, you buy things for the house, you buy refrigerators. With the space, you get a car parking slot, you get another two-wheeler, you get another car, and all of that stuff could be a phenomenal plus if the government was to take advantage of that, come Monday's budget. But in any case, with demand tapering in December, the government, of course, they've said this budget will be something like we've never seen before. They've not said good or bad. Hopefully, it is on the good side. And they will hopefully stimulate demand. And they may not worry too much about the fiscal deficit in the near term, because many countries around the world have got high deficits. So India would not be an outlier if the government was to continue spending more than it was earning in terms of taxation. And I think the known unknowns, right? We talk about that, what's going to happen with COVID in the US, in Europe, in Australia. Are they going to remain in animated shutdown for much of 2021? What does that mean for demand in those countries? What does that mean for consumption pattern in those countries? What does that mean for raw material prices, for the price of oil? And of course, the Indian rupee and the Indian trade deficit is influenced very strongly by what happens with the price of oil in the global markets. And then, of course, the question of the vaccines. Um, there is no proper study as yet, but whatever little study they've done, they're not sure whether the vaccines will actually stop transmission. So you should think of the vaccine as something to help yourself, that by taking the vaccine, you have a lower chance of getting COVID. That still means you have the virus in you and you could be transmitting it. So you could be, those asymptomatic carriers that we've read about in the last few months. We've also been learning new terminology all these months over there. So we're not quite sure how the vaccine will play out, but yes, for the moment, we are all trying to get vaccinated across the world, including in India. And the unknowns for everyone. We have no idea what's going to hit us again. We have no idea what the unknowns are for everyone. We don't know what's going to hit us. We don't know whether it'll be a spike in inflation, whether it'll be a reversal of interest rates around the world, whether, God forbid, there's another kind of a pandemic or this virus changes and mutates and the vaccines are not sufficient to subdue it and to keep it in control. So there are a lot of unknowns out there. We've all become more aware of what can go wrong now in the world, having lived through the 2020 crisis of COVID. So with that, I'll turn over to Chirag, who can talk about the different asset classes that I think will be open for questions. Thank you.
Sure. Thank you, Ajit, for giving that background of how India looks like today. And it's kind of one of the better places today for economic activity. And there could be unknowns that, there could be. But there are certain things that can, remain with us even after all this is over. One is government policy. So we'll talk about how the government policy has shaped up and how it's going to likely behave in the near future. So the very question that remains on everyone's mind is the V-shaped recovery that we have seen, will it sustain going forward or not? Initially, we have communicated in the past that any recovery that we see from the lows that we had seen is going to look like a V-shape. But will it continue the same momentum or will it slow down? That's the main question, and that is what will drive markets going forward, right? So let us look at certain things like the growth projections, if you see going forward, are very, very optimistic, right? Everyone is looking that there will be 2 years of good growth across the globe. India is going to be, as forecasted by IMF and others, India is going to be the fastest growing economy in the globe. So there is an expectation of high growth next 2 years. But as Ajit explained, that there are unknowns, right? Which can have a certain kind of impact on this economic activity or on these expectations that we have. What we see on the left-hand side of the chart is the stock markets initially collapsed. Central banks pumped in a lot of liquidity, and that's what driven markets higher back to the much more than the levels that what we were before COVID, right? And with this, this liquidity, this rebound in activity, there is expectations of growth going forward. So if you were to take cues from what we have seen in the past, is it going to be a momentum that keeps continuing? Or is it something that what we saw was V-shaped and now it's going to be gradual, right? So if you see from a job market perspective, the jobs are real economy. What central banks do, what equity markets do is markets at the end of the day, right? What is the real economy showing us? It is showing us that we have recovered on the jobs front. If you see the US, the red line there, which show us big spike in terms of unemployment, and it's now coming down, which tells us that we have recovered. We have recovered half of the jobs lost. And from now on, if you take Q, what is on the right-hand side of the chart, it tells you that from now on, it could be more gradual recovery than what we have seen as a V-shaped recovery, right? A 2008 crisis took 7 years to normalize in terms of the employment levels, right? This crisis was much more severe, it could take much longer. Of course, the impact of government policies, monetary policy has been much more and has been supportive of for the rebound in activity. But from now on, it could be gradual. If you see the orange bars and the yellow bars on the chart, it tells you that how much jobs you have lost and how much time it takes for the economy to recover. It looks more or less in sync, right? And therefore, here this time we had lost a lot of jobs, and therefore it will take its own time to mend, to recover back to the levels that we were at earlier, right? So it could take, like World Bank chief economist says, it could take about 5 years to get to the same employment levels that we were before COVID, right? So it's going to be gradual recovery from here. Policy response, what we have seen on that front is a significant reduction in interest rates. Interest rates were dropped to zero levels in most parts of the Western world. Even in emerging economies, there was significant reduction in interest rate levels. And as you have seen after 2008 crisis, it remained at the zero bound in the US for 6 years till you saw good recovery happening, like you had most of the jobs get replenished. Until then, Fed kept rates low for that much longer, right? So this time also, they have cut interest rates. They will keep interest rates for a fairly long time. So central banks, in do whatever it takes approach that they have adopted, they will keep interest rates lower. Another thing that what they have done is pumped in a lot of liquidity in the markets, right? If you see this time, it's more than $9 trillion that they have pumped in. It's much more than what we have ever seen, right? 2008, it was just about 3.1 trillion over 5 years or so, right? And this time it's 9.2 trillion in less than a year's time frame, right? So it's much more money being put to work by the central banks. And in times of giving support to the economic rebound that we are seeing, this is going to stay along with us. Central banks will stay supportive, will stay accommodative. They'll keep interest rates low. They'll keep printing more money. Governments have also not been behind in terms of supporting the economy. Across the globe, we have seen various fiscal stimulus measures unrolled by the government. In various economies, we have seen like 3-5%. In some economies, we have seen 10-20% kind of numbers as well. So governments have done a lot of fiscal stimulus measures to support the economy in the depths of COVID. What this has done is taken the debt levels at much higher levels. Today, we are staring at significant high debt to GDP ratios, something what we had seen in the World War II era, where governments had to pump in a lot of money to support the economy in those times, right? So even this time, you have seen the debt levels rising significantly. And whenever we have seen debt levels rise to very high levels, it kind of impacts growth, right? So this tells you that, yes, we are staring at a much adverse debt levels across the Western world, at least. And that is going to be impacting growth. And therefore, the monetary policy, what we have seen accommodation from central banks, is going to be an important driver going forward. So with all this macro backdrop that we have seen in terms of policy responses, what are its impact on various asset classes? Let's start with gold. Given that we are talking global macro, gold is what is driven by global macro, right? One important thing, what we have seen is interest rates going down. There is some bout of inflation given there were supply side constraints, given there is so much liquidity, there is some inflation out there. So real interest rates, which is interest rates minus inflation, is gone to negative levels in most parts of the world. This is chart of US, where US real interest rates is negative. And whenever we have seen negative real interest rates, usually gold does well, because holders of fixed income instruments say, when I hold this instrument on a real basis, I lose money. I move to an asset class which will preserve my purchasing power. And therefore they flock to assets like gold, right? And whenever we see, be it 1970s, be it aftermath of 2008 crisis, when we saw negative real interest rates, gold did really well. The big rallies that we have seen in gold came at those times. This time again, we have negative real interest rates, and which will support gold going forward. This is not changing, as we said. Interest rates will remain low for a fairly long time, and therefore the advent of negative real interest rates may continue going forward, and which will support gold. Another thing that will help gold is a weaker dollar. US has been at the forefront of stimulus measures. The monetary policy has been most aggressive in the US. Therefore, it put pressures on the currency in the US, which is US dollar, right? If you see the projections of US deficit going forward, till 2030, every year, they will keep doing more than $1 trillion of stimulus, right? And therefore, they will remain, they'll run deficits for a fairly long period of time, for next 10 years at least. This is projections from US CBO itself, and it tells you that they will keep running deficits going forward. The debt level has been inching higher, and in this 2020, it's gone above that 100% mark, more than 120% of GDP. GDP will recover a bit, which will bring those debt to GDP measures a bit lower, but still it is very high level of debt. And both these combined continue to run deficits. High debt will make holders of US dollar or US treasuries nervous and kind of lose their confidence and therefore make them move out of it. So this will make dollar really vulnerable, and we expect weaker dollar going forward, which is also going to support gold. Many people say that, our conversations with investors that gold has already risen so much. Is it kind of speculative? Is it a bubble? No, it's not bubble, right? This chart gives you that evidence. The red line is the money printing or money supply in the US, and gold being a monetary asset at the end of the day, has to comprehend to how much increase in money supply has been. And if you see today, it's neck to neck. So gold seems fairly priced at this point in time as compared to the increase in money supply that we have seen, right? Do we expect money supply to increase going forward? Yes, because central banks will remain supportive. So if the red line inches higher, the orange line, which is gold, has to move higher along with it. So gold seems fairly priced at this point in time. Looking at the factors, we think that gold prices could be headed higher. So what lies ahead for gold? What will lead to higher gold prices is negative real interest rates. Negative real interest rates, just to again come back, what it means is interest rates minus inflation, right? That is likely to remain lower. Interest rates going to remain lower for longer. There will be policies, quantitative easing policies, which is nothing but money printing by central banks, continue, and there will be weaker dollar. If all these three things continue, there will be higher gold prices. If there is a surprise rebound in economic activity, much better than what we have seen or what is anticipated, then there will be lesser need for lower interest rates or quantitative easing policies. Inflation might be a little hotter, and that would lead central banks to inch interest rates higher, and that could lead to a toll on gold prices. So overall, looking at the factors, it looks like gold prices may head higher, but you need to also keep under consideration that these factors, especially surprising high economic growth, could lead to gold prices coming lower. Coming on to from gold to debt markets, we have seen various policies unfold by RBI and how it's going to impact debt markets, right? What we have seen is government borrowing has been high because they have run high deficit this year. So fiscal deficit as a percentage of GDP is in excess of 12% this year. Even next year, with the rebound in GDP growth, it's not going to come down tumbling. It's still going to remain high, about 10%. So there will be high government borrowing to take care of this fiscal deficits that they're running, right? What runs to India's advantage is, given that interest rates in US and other markets have been driven much lower, the differential between the 10-year in the US and the 10-year in India is still pretty high. It still stands at 4%, right? So if you are a foreign investor and you're in search for yields, given interest rates in the US and other Western countries are at zero levels, they will look at Indian markets, which offers a pretty good yield differential of about 4%, right? So they will come to Indian markets in search for yields. And inflation differential, which kind of leads to movements in yields, is also favorable at this point in time. It's lower than what it used to be. And therefore, there is a high probability that these foreign investors may come to Indian shores in search for yields, in trying to unlock the yields that they get in Indian debt markets, right? And there is significant amount of money out there. If you see OECD pensions, that is the Western world pensions, they are 32 trillion. 1% of that itself is going to be $320 billion, right? And total size of the Indian bond market is about 2 trillion. But if you see foreign ownership is just $40 billion. And if you just see in the sovereign government bond market, it's just 0.1% is $21 billion. So given that they earn negative interest rates, 25% of the world investment grade debt is negative yielding today. And India is still at around 6% yields, offering a much good spread for these investors who are looking for yields. So there could be significant amount of foreign flows coming into Indian markets, right? One more thing that could happen is what government is toying with the idea or trying to move towards it is including India in the global bond indexes, right? India is currently not in any global bond indexes, but they are trying hard to push India into the global bond indexes. If that were to happen, India will have a good weightage in these global bond indices and will be able to attract a lot of flows from there. So if it, for example, if it gets included in the JP Morgan bond index, that is the emerging market bond index, then you could expect India to get flows of 25 to 30 billion. If all three indexes, it kind of gets an opportunity to be part of it, then the flows total could be 50 to 60 billion dollars. If these kind of flows come to Indian markets, yield are bound to move lower. So what lies ahead for bond markets? What's the one big thing that can move bond markets is if we get these flows, what will happen if we get these flows is deposit rates will decline. What we see as FD rates, which have declined already substantially, may further go down. And also with it, the borrowing rates will move down, like mortgages, auto loans, all those rates will decline. What could happen what could go wrong here is if we do not get flows enough that could offset the high government borrowing that we are seeing in next 2 years. If that doesn't happen, then yields could move the other way around. There could, because of the supply from the government, the yields can move higher than what we anticipate as moving lower, right? So it boils down to the foreign flows. If India becomes recipient of that, it's going to be a boom for debt markets. Coming from debt markets to equity markets, we have seen various policies by the government. The global backdrop, we've seen what kind of impact it is having on equity markets. What's one big mover that could move equity markets? First, looking at what we saw because of COVID, there was an elevator down. Stock markets fell sharply across the globe, India, emerging markets, US markets, right? And then we have seen as there is this rebound in economic activity and the COVID influence got lesser, stock markets have recovered much more than what they were before COVID, right? India growth fell sharply by about 24% in the June quarter after COVID. And we have seen a very sharp rebound in Indian growth, right? What has happened is India has faced a lesser brunt of COVID as what we would have expected at the time in March. Economic activity has resumed significantly, and the impact is not much. We're seeing a reducing impact on growth. And this shows that Indian economy is resilient because it relies on internal consumption. And given that economic activity has rebounded, consumption spending has increased. Even we are seeing signs of upgrade in earnings given economic activity has rebounded. Of course, 21 will see a sharp deceleration. 22 will see some recovery, and 23 will see some momentum in earnings. That's what is the base case looking as of now. What has also helped Indian markets to ride to levels that we have seen is strong inflows over the last few months of 2020, right? 2020, despite being the year that it was, has seen net flows of $23 billion from foreign investors, much higher than what we have seen over the last few years, right? There was a sharp increase in local activity over the last few years, but 2020, we have seen some nervousness, some money moving out of equity markets. So if foreign flows continue, it will be supportive of equity markets in India. And given that India is a fastest growing economy, or would be a fastest growing economy likely in 2021, investors chasing growth or looking for a source of yields will come to Indian shores. So you could expect some foreign capital coming into India as we've seen in last months of 2020. What has happened is the PE levels, the price earning ratio, has ballooned to levels not seen before. It's at 37 times PE, but much of it has to do with the earnings collapse because of the quarter of June 2020 that we had seen, right? Once that is behind, once you look at this thing post that 12 months of that quarter, you will see much better PE levels likely. And what seems like a stretched PE ratio may become a bit more normalized. What could support equity markets is, one is flows that we have seen. Another thing that could help equity markets significantly and help earnings and a better recovery is if there is a revival, if there is a boom in the real economy, which could be on account of revival in real estate, right? We have all seen the advantage of lower interest rates. We have all seen advantage of what Ajit alluded to, like what happened in Maharashtra, the stamp duty cuts with lower, some discounts on housing prices has led to buying in real estate, which we had not seen over the last many years. In 2020, the sales have been much more buoyant than what we have seen before. And there is a real advantage to all the buyers. Like, for example, interest rates, the percentage saved due to low interest rates is about 10%. So that, along with other incentives, have led to more buying. So if there is a policy that drives a boom in real estate, and that could be very much supportive of overall activity in the economy. It could drive significant amount of spending. It could lead to job creation. It could lead to a lot of cascading impacts in the economy, which will be a lot more positive for India, right? So what could really create a boom in equity markets is if there is a real economic activity which kind of revives very strongly. And real estate could be one of the very important drivers if there is good policy making that supports and gives incentives for that revival. Second thing that could lead to real economic activity improve, because given that foreign companies are trying to reduce their reliance on India, on China, given what has happened in 2020, they are looking for diversifying their supply base. And if that happens, India could be a beneficiary. But policy making has to be supportive of inviting these factory relocations. If that doesn't happen, then it could not lead to a boom. These two things are very important drivers that could lead to a boom in economic activity, aided by flows, could lead to markets moving much higher from here. What could go wrong is poor government policy. If government policy does not help these factories come and relocate to India, if government policy doesn't incentivize things like real estate, if government policy scares foreign investors coming into India, then that could be a problem. Second thing, as we know, COVID is still a very uncertain thing. And if there are resurgence in COVID cases, if the vaccine vaccine rollout doesn't happen as we all anticipate, that could lead to a impact on equity markets. So all in all, this is what we see. Recovery plus strong flows can drive markets higher, but government policy can be one thing that could hamper what we see. So as we know that COVID is still uncertain thing, it's still not behind us, though we kind of feel that most of it is behind us, but it could be one joker in the pack. And if there are uncertainties relating to COVID, how are markets likely to behave? How are asset markets likely to behave, right? So if you look at 2021, if COVID recedes and normal activity keeps moving forward as we have seen over the last few months, then central banks, if you know, will stay accommodative for some more time, at least the global central banks, before they kind of start tapering their policies, right? So that will, given that they remain accommodative for at least some time, it will be beneficial for equities. Given that they will be tapering, it will be negative for debt. It will still be somewhat positive for gold, right? Normal activity will lead to good earnings and therefore a strong way of spending, which will be very beneficial for equities and not so good for debt and gold. Corporate and government balance sheets will improve significantly because economic activity resumes, governments will collect more taxes, corporate balance sheets, corporates will have more sales, that will lead to improvement, and therefore that will be better for equities and debt and not for gold. There could be some bout of inflation out there, which may be positive for gold. Limited inflation is good for equities because nominal growth is that much higher. So equities will do well. It will not be good for debt. It may be a bit better for gold as real interest rates become that much negative. Right. So all in all, if you take a tally of if COVID recedes, equities will be a beneficiary as compared to debt and gold. It's better to stay in equities if you anticipate COVID receding. But what happens if COVID lingers? COVID stays with us for all of 2021, right? It could lead to anticipation or what we expect on earnings or sales of corporates that could lessen because there will be recessionary kind of conditions. People will be conservative, not spend, and therefore that will be bad for equities, right? And that may be good for debt and gold, given that central banks will stay accommodative. There will be risk aversion out there, and therefore that could be better for debt and gold. Central banks will remain a lot more accommodative for a longer period, and they may boost more accommodation, and that will further boost economic growth. That could be positive for equities, debt, and gold. Liquidity is tossing around because of central bank activity will lead to more inflation and asset price inflation per se. That will be good for all asset classes. If COVID stays, then there will be lower taxes because spending will be lower, incomes will be lower, therefore lower taxes for the government, and they will have to spend higher to support the economy. So it could be better for equities, but bad for debt and good for gold. So net, if you see, if COVID lingers or stays with us in 2021, equities is not the preferred asset class. You need to stay a bit cautious on equities. Debt and gold will be preferred asset classes. The recessionary conditions, less spending, and optimistic expectations that we have now on equities will all go off, and therefore it may not be really well suited for equities, even though the other things like central bank accommodation and government support for the economy may be better, but still the recessionary conditions will kind of overweigh on the other factors. So overall, if COVID lingers, stay cautious on equities, be in debt and gold, right? So we don't know how it's going to pan out, right? Exactly if COVID stays or COVID goes off. And it's very difficult to predict which asset class is going to be the best asset class to be in, right? Like it has been difficult all these years to predict which asset class will do well the next year, right? And so is this year, because there is some amount of uncertainty every now and then, which kind of makes these predictions not right. Even for it stays true for 2021. So stay invested across asset classes, have a mix of asset class. You could have your expectations and you can change your weighings accordingly in which asset class you want to be more and which asset class you need to be less. But each asset class serves a purpose in your portfolio and you need to be in all asset classes at all times, right? That is what we do in the quantum multi-asset fund of funds. We diversify across asset classes. We change the weighing of asset classes, change the allocation to equity, debt, and gold, depending on what scenario or what valuations kind of tell us. We look at various indicators that help us make that decision. And we try to be a truly balanced fund. We not biased to a particular asset class. Our equity debt allocation are between 25 and 65%. So depending on how we see things unfolding, how we see the valuations in each asset class, we position ourselves accordingly. What we try to do is try to aim and reduce volatility of returns that you have, and to give you that smooth ride and predictability of performance year after year. So this is how we have navigated equity markets in the quantum equity fund of funds. Before COVID, equity markets were running at very high valuation. So our equity valuation was at the lower end of the spectrum. When equity markets fell sharply, we increased our allocation significantly from 27% or to about 50% equity allocation. And now when we have seen a big run up in markets and markets looking expensive from a valuation perspective, we have brought down our allocation to equities. So at each stage, what we are trying to do is reduce the risk that you take with your allocations, right? And at the end of the day, what are we trying to do is trying to give you a better return than what your fixed deposits will give you, right? So, by choosing a judicious mix of assets so that you get a better return, and at the same time, you don't end up taking overtly high risk, right? So if you see, this is each point on this graph is a 3-year rolling return of the quantum multi-asset fund and a SBI 3-year SBI fixed deposit. We have taken SBI 1-year fixed deposit returns, and we have used a quarterly compounding, which usually doesn't happen, but still we have given that advantage to fixed deposits. Still, despite that, most of the times you would have earned better returns than the fixed deposits on a rolling 3-year basis, right? About 17% of the time, especially in the COVID kind of time frame, which was very, very uncertain and equity markets take a toll, we had seen lower returns largely in that time frame. But overall, if you see, only 17% of times, only after 336 days after 1969 days, we have done inferior as compared to fixed deposits. But most of the time, we have done better. So if your horizon is 3 years and more, if you're looking to a one-stop solution to, that could endeavor to get you better returns than your fixed deposits while taking a slightly higher risk, then this is what you can look at as a solution for your need. And with fixed deposits, you would also seen in recent times, we have seen various banks that have had a tough period, and your money got stuck, or investors' money got stuck in such banks. You don't face such kind of things with a multi-asset fund, given it invests in all liquid instruments. So that risk is avoided, and there is a higher chance of you earning a better return than your fixed deposits. If that solution doesn't fit your bill, we still tell you that you stick to an asset allocation strategy. That is a must in any kind of market scenario. And if you want a simple solution for that, what we tell you or what we recommend is keep about 24 months of money, that is 24 months of expenses. So if your expenses is say 1 lakh a month, then you keep 24 lakhs as safe money, right? Into a very, very safe place, very, very liquid place that doesn't have any chance or any probability of losing money. And whatever money that you have after that, you split it between equity and gold in a ratio of 80-20, right? 80 equity can be split into various different styles of investing, like the long-term equity fund, the quantum equity fund of funds, which are very diversified basket of funds, and the quantum ESG fund about 10%, right? So if you do this, this has worked in most of the times in most of the asset cycles, and it has worked wonderfully well for investors. So either you can choose a ready-made solution like a multi-asset fund if it fits your style, or you could choose something like this, which is a very simple way of diversifying your assets and still do well. Right. With that, I will hand it over to Ghazal take any questions that you may have.
Thank you, Chirag. Thank you, Ajit, both of you, for taking us through the outlook for the various asset classes and sharing the merits of asset allocation. But before we jump into the Q&A session, I quickly want to introduce the SMILE facility to all of our investors. It is an initiative between Quantum Mutual Fund and Help Your NGO. This facility enables an investor, on the basis of his or her consent, to contribute some percentage of their investment with Quantum Mutual Fund towards a charitable cause to any NGO registered with Help Your NGO Foundation. To know more about this, please visit our website and check out our FAQs on Smile or reach out to customer care. Now, moving on to the Q&A session. I'll start with you, Ajit. With regards to the COVID landscape, do you think there's enough testing which is taking place? And do you think the data and the results are being displayed accurately? Also, does misrepresentation of numbers and the severity of COVID have a bearing?
Thanks, Ghazal. I think I heard your question. Yeah, sorry. I think I heard your question about testing, correct? And
Yes.
whether we've done enough in India. I think India's done a remarkable job of getting the testing right, of trying to figure out what's there. As some people have noted on the chat, I was very critical of the government in the start, and they were very, very slow in understanding the problem, and they seemed focused on other things when they did the shutdown or the lockdown in March. But I think they quickly ramped up everything. They understood the problem, and I think the medical fraternity obviously stepped in. So I think they've done a great job, and I think the test, there's always going to be complaints. I know that in the city of Bombay, in the city of Mumbai, I think the Maharashtra government on the BMC has spent more on trying to build a coastal road than they have spent on healthcare. So you will find these sort of local problems that, where not enough focus was there. But there's something else, may just be luck, that we've been lucky with the virus, and we've not had that strenuous, that much of a strain on the healthcare system. So while I don't necessarily say I fully trust the data, I certainly trust people's experiences. And over the last month or so, we're not hearing many of our friends or relatives getting impacted by COVID. I mean, there are some cases, obviously, but it's not as widespread as what it was before. So I'm actually pretty optimistic on India's handling of COVID. But having said that, I should confess that I had given a prediction that COVID would end by July 22nd, 2020 in the world. And that was completely wrong, because I think human behavior, everyone started going out again. And so that was a big problem, that COVID kind of resurged. So that was not good. So, hopefully we don't have much of a problem in India, but I think we will have many problems in the world. And I'd like to just, I know that Chirag ran through a bunch of asset classes and situation analysis of what could happen in the different scenarios. It is, I think, you have to be careful, because there could be combination of things that are going on. The Western world could be more impacted, and India could be kind of lightly let off in some sense. Flows from the Western world could move onto India and help us even as the world suffers. Or if the Western world is frightened about where the dollar is going or where the fiscal crisis is going in the Western world, money could leave India and go back. So there are many, many variables in addition to our own budget and our own local policy making. There are many, many variables out there.
Sure. Ajit, what are your views on the stock market rally? Is this sustainable, or is this the right time for investors to book profits and exit since valuations are elevated?
Is that a question for me, Ghazal, about
Yes.
about the valuations?
Yes.
Sorry. So yeah, so I think equity, so where value, well, at least I personally am a value investor. So when we come to the solutions that Chirag showed, and you can show that again, the slide of the different funds that we recommend on the solutions. But I personally am a value investor. So as a value investor, we've had to struggle. There was a question that came out there, that when will the long-term value fund perform? Well, we've had a phenomenal performance from the lows of March for the quantum long-term equity value fund till now, till November, December. We've had a very good run-up, even though we did not own Reliance. And there are certain shares that we will not own because of governance issues. Reliance is one of them, and there are others. And some of these shares tend to be large weights in the index, and they tend to be owned by other mutual funds. So it's not that it's right or wrong. The scoring systems that we have will not allow us to own Reliance, and that's because we think something is not very good on the governance side, etc. But but sometimes that hurts, sometimes that helps, and it's hurt quantum because if you go back from May 2014, when Narendra Modi became Prime Minister, and you go all the way till till January of 2020, till a year ago, before COVID, 70%, approximately 70% of the entire gain in the index was three stocks: HDFC Bank, Reliance, and HDFC. And of those three, we owned only one. And you can say, well, it's your fault for owning only one. But that's our style. The value style of investment did not allow us to own HDFC Bank for many years, did not allow us to own Reliance for all those years, and probably in the future too. And when the markets corrected in March, we went in and we bought HDFC Bank. So, sometimes market dislocations give you opportunities to go in and act and go in and buy shares that we think are inexpensive. But markets are expensive if you look at interest rates that we're used to. If the SPI FD rate was 6 or 7 or 8%, I tell you very bluntly, this market is very expensive. But the SPI FD rate is not 6, 7, 8, or 9%. It's lower. And therefore, from that perspective, you have to think of interest rates and equities as kind of opposite ends of the spectrum. When interest rates are high, equity valuations should be low. When interest rates are low, equity valuations can be higher. So we're in that end of the cycle in the world and in India. And particularly, we saw the recovery graph where although India has recovered, which Chirag showed the escalator down and the step up, but India is still trailing the world markets. India is still doing, worse than the world markets. So it's not that India's had the best stock market in the world. No, India, like other markets, has done well. And, yet the world markets have done, even better. They didn't fall that much, but so they've done much better. So there are various things that impact where we stand today. And I think there's a lot of uncertainty out there. And the only solution, in my view, is if Chirag goes back to that circle with the allocations that we have, is rather than time and asset class and try to figure out which asset class is going to do better than the other year on year on year. And you don't know that. No one knows that. If you have a diversified portfolio, and Quantum has built it with the equity fund of funds, it's a very unique product. It's a debt fund, yes. You invest in it and we fan out the money to 6 other funds that we like, managed by other fund houses. And by buying this basket of the Quantum Equity Fund of Funds, the Long-Term Equity Value Fund, and the newly launched India ESG fund, equity fund out there, you actually get all that you want in equity. And you blend that with the gold on the left and blend it with the liquid fund or the debt fund. That's it. You come to one house and we've taken care of all your needs. I have to apologize. I'm in a place where I think there's some tower problems. So my bandwidth is low. So I'm trying to shut down my video as much as I can, not because I don't want to be seen, but just to avoid the bandwidth issues that may arise.
Sure. Thanks, Ajit. Chirag, coming to you, given the interest rate scenario, which one would you say is a better portfolio diversifier, gold or bonds?
Currently, if you see, gold is a better diversifier because if interest rates have been moving lower, inflation is slightly higher. So on a real basis, you might end up having certain negative interest rates or just about even interest rates. Whereas gold, if you see what we've seen in times of COVID, any kind of uncertainty that kind of strikes your allocations, gold is the one that kind of shines and helps you during those times. So given that fact, I think gold is a better diversifier. And as we have seen that it's kind of fairly priced at this point in time. But if you see the factors, they are kind of still more supportive. So from both perspectives, looking at the scenario, the unknowns that we are talking about, the uncertainty that we are talking about, and the fact that factors are positive, we kind of favor gold as compared to bonds. But still, it's not, I would say it's not debt or gold, it is debt and gold. You need to have presence in both the asset classes. You need to have a diversified portfolio, and both will warrant an allocation.
Some more questions on gold, Chirag. Do you think gold has run its course? You had predicted an all-time high of gold touching 75K. Does that assumption still hold true for quantum?
Well, 75,000 was given what would likely happen if gold were to reach a certain level and rupee going to a certain level. But given the factors, we still think there could be some further room for gold prices to appreciate. We have seen, as we have shown, it's kind of still about fairly priced based on money supply, given gold is a monetary asset at the end of the day. If there is further money printing by central banks, which likely will be, in that scenario, there will be, gold should move ideally higher. Interest rates will remain low for a fairly long time. So I think savers will at some point in time say, I need to move out from this negative yielding asset or real interest rate based negative yielding asset and move into assets which kind of give me a chance to earn at least the same kind of return, right? Even out my purchasing power. So from that perspective, I think there is more scope for gold prices to move higher. And at the end of the day, what we tell investors is have an allocation to gold and pray hard it kind of reduces to half the very next day. Because if it goes down, your other assets will likely to do well. And when your other assets are not doing well, gold will do well. So look at it from that perspective. Gold appreciation is just like an icing on the cake. And given the prospects, we still think that we will get that icing on the cake.
Sure. Chirag, given that gold has a negative correlation with equity markets, what percentage of investments should be towards gold ETFs?
We recommend, like if you see this asset allocation strategy, after 24 months of safe money, we recommend that we split between equity and gold by 80-20. Or if you were to have a simplified strategy or some other strategy, 10 to 15% allocation to gold is ideal in all kinds of market scenarios. At 10 to 15%, what does gold do? It kind of adds to your returns, doesn't diminish your return, and at the same time lowers your risk considerably over a long market cycle. So 10 to 15% is a tried and tested, hard numbers backed allocation that we have found that at 10 to 15% gold is an optimal allocation. Beyond that, it kind of starts impacting the portfolio return overall. And at 10 to 15%, it kind of adds to returns and lowers risk considerably. So a 10 to 15% allocation is what we'll recommend. Or you could go by this formula of safe money and split between 80-20 equity gold.
Thanks, Chirag. Coming back to you, Ajit, what is your analysis of a soft dollar policy on our capital markets?
Sorry, a what policy?
Soft dollar policy.
Soft dollar policy. So I saw a related comment there that, I predicted the rupee will head to 85 last year after the COVID hit us. And do I still stand with that? So, to some extent, I think we need to, step back a bit. That 85 rupee estimate that I gave assumed that we'd have 90 days of lockdown in the world and the world would recover. And I was seeing what Australia and UK and the US were doing to get their economies going and what India was not doing to get its economy going, i.e. in Australia and UK and USA, they were actually sending checks to people so that they could survive in lieu of the lost jobs or the lost income. Whereas in India, we still have not done that in India, which is still, in my view, a risk. So based upon all that, I expected a faster recovery in the Western world. As we've seen, the Western world is dragging, and India's economy is actually recovering. May not be back to where we were pre-COVID so quickly, but we are going to be recovering while the world will still sort of struggle. And I think what's happened in the last 6, 9 months has been that the fight between China and the US, or war actually, as someone called it, the war between China and the US has, become more, has kind of accelerated, and there seems to be little sign of it getting better. All of this has actually made people more nervous about the US dollar because, as you know, China owns trillions of dollars in its portfolio. And the fear is that China is already selling dollars and effectively bringing down the value of the dollar against other currencies. So the Indian rupee has gained, since COVID, has gained roughly about 4 or 5% against the US dollar. But the Indian rupee has lost about 10% against the pound, about 10% against the euro, 10% against the Canadian dollar, et cetera, et cetera. So India has lost it, the Indian rupee has lost its value against many currencies, but has actually gained against the US dollar. So, so that's where we are today. Where will that continue? How will that continue? Recognize that India still needs capital to grow. We're a growing economy. We don't have enough savings within the country to fuel our needs for economic growth. We have to import capital, whether that capital is money coming into venture capital, into private equity, into real estate development, into IPOs on the market, or into bond money which comes in for home loans and given to banks, and then they can lend that further. So India will continue to be an importer of capital. And historically, countries that are importers of capital have have got generally a weak currency relative to other currencies. The exception, of course, being the US dollar, because they were the reserve currency of the world and have been for a long time, ever since it took over that mantle from the British pound around World War II. So you do have this situation where I think the rupee will continue to weaken. Its strength is relative. It's strengthened against the dollar, but please look at the numbers versus the pound, or the numbers versus the Swiss franc or the euro or the Japanese yen. It's down by anywhere between 8 to 12%, depending what day of the week you look at it. So the rupee will remain soft, will continue to weaken. It has strengthened against a weakened US dollar. That's where we stand today. I'd just like to touch upon something that Chirag spoke about on assets. I think one of the key messages and one of the key learnings for everyone over the last 12 months should be make sure I have enough money in the bank or in a liquid fund to tide over a crisis. And I think that's something which you must take away from this webinar or from your experience of the last 12 months. You should have money easily accessible under your mattress, in your cupboard, in your wallet with your favorite bank or with your favorite liquid fund. And you should keep it for 6 months or 9 months or 12 months, or in my case, for 24 months of expenditures should be covered. Because I think you don't know where the next shock is going to come from. You should not have any tension in your life. And, don't think of investments as a game. Investments is a path to your future, a path to your stability, a path to deliver what you want. It's not an end in itself. And so you should think of it as a means, to get to somewhere, a means to be stable, a means to be kind of more in a steady state, if you will, as the world around you is rocking. So please make sure you always diversify and don't chase returns in equities or chase returns in gold or chase returns in any kind of hedge fund or mutual fund or any kind of Robinhood scheme, etc. Over to you, Ghazal, sorry.
Thanks, Ajit. The next question is also for you. what would be the impact of stalling of reforms like the Farm Bill in the overall India growth story? And do you think it will impact foreign investments in India?
So for this, you should at least see my face because I'm smiling a bit, right? People are going to expect a view from me on the government's handling of the Farm Bill. So, I think that should there be agricultural reform? For sure. Was it done the right way? Probably not, as we can see from the protests that are going on. So, will, I don't know what's going to happen, but I hope there's a dialogue and I hope there's an explanation. And I hope that, the two parties, the farmers and the government, come to some conclusion on where agriculture has to be for the next few decades. It's a long drawn out procedure. Recognize that whenever there have been reforms in the financial sector, the introduction of SEBI, the introduction of foreign investments, the creation of mutual funds, et cetera, or even the 1991 reforms, there was discussion, there was some debate, there were policy papers, as there have been on the agricultural side, but very rarely has something been rammed down someone's throat, and then you get the reaction that you did. So without justifying one side or the other, there clearly must be farm reforms, but there must also be a recognition that you have a large amount of people living off the agricultural sector. It may be only 22% of GDP, but it's about 60% of total livelihoods depend around agriculture sector and agriculture and allied sectors. And as you reform that, you better make sure you have job opportunities for those who you wish to displace from off their farms to something else. And just another sort of caveat there, around the world, there is a trend for localized farming as opposed to mechanized large-scale farming. So India actually has smaller scale farms. What the Western world is trying to head towards, and you can check this as you've got friends who are farmers in California or wherever they grow crop, they actually get paid more for their produce if they're using natural ingredients than if they're using seeds and fertilizers that come off any kind of manufacturing line. And I'm sure you'll have seen enough articles on that. So in some sense, we actually have localized farming with small farms. We don't have it efficiently. We don't have enough refrigeration. We don't have storage. We don't have the proper mechanisms to ensure that the farmer gets what they deserve in terms of price points. But clearly, I think there should be a rethink on policy. It's also linked to, in some sense, to climate change and to other things that are going on in the world, which India is not yet fully discussing or fully aware of. And we launched the ESG fund in some sense to make us more aware of what's happening on environment, in society, the S, and on governance of companies, which is the G, and how can we actually profit from moves that may happen on the ESG side. So that's what that fund is about. But I think that the way the Farm Bill is handled will probably put off foreign money, will put off foreign investors, will put off foreign governments. Having a Farm Bill, of course, will excite people who want to invest in the country, particularly in the farm and agricultural allied industries, from storage to seed, etc.
Thanks, Ajit.
Ghazal, back to you.
Chirag, some questions on the multi-asset fund coming your way. What is the difference between the quantum multi-asset fund and other balanced funds? What gives you an advantage?
Sure. Firstly and foremost, when you look at a multi-asset allocation fund, you need to see that that fund is not biased towards a particular asset class. Most of the balanced funds out there are biased towards equities, meaning they have a minimum allocation to equities of 65%. So even if the fund manager is not comfortable with the equity market valuation, he still has to risk your money in that asset class, right? So that is for the most important thing when you look at a balanced fund or a multi-asset allocation fund. It cannot be biased towards a particular asset class. It has to give the fund manager enough flexibility to move in and out of an asset class if the valuations are not in the interest of investors, right? Like what we have done for the quantum multi-asset fund of fund, the range is 25-65 to equity and debt both. Both have an equal range. So we are not biased towards a particular asset class, especially equities. When you have a 65% allocation to equities, like most of the balanced funds do, they are having risk return profile very much close to what an equity fund will have. So if you look at March 2020, the fall that we saw in equity markets, most of these balanced funds fell along with the fall in equity markets. Whereas if you see the fall for the quantum multi-asset fund was much lesser, given that we had a very low allocation to equities, unlike the 65% that most of them had. Plus we had allocation to debt and gold that helped us to tide or give better returns or lesser downside as compared to most of those funds. So that is a unique advantage that we have, the way it is framed, or the allocations ranges that are the asset allocation that we have. That gives us a unique advantage not to risk investors' money when it is not conducive to do so, right? So that is what we have done in the multi-asset fund at all times. What we are trying to do in the quantum multi-asset fund is to give you an alternative to fixed deposits. And at the same time, by taking a slightly higher risk than your fixed deposit, it gives you a very liquid alternative that endeavors to get you that higher return than what a fixed deposit will give you. Also at the same time, if you see the standard deviation, the volatility of returns is not very high, right? That tells you that you're going to have a smooth ride in terms of returns, very, very predictable. You will know if equity markets at all-time valuations, you will anticipate a lower allocation in the quantum multi-asset fund to equities. So that is what we are trying to deliver, and that is what gives us an edge in terms of what other funds don't have.
Chirag, the multi-asset fund is taxed like a debt fund. Is that a disadvantage?
So that's a myth, actually, what most investors have. If your time horizon is more than 3 years, right, you get an indexation benefit on funds that are taxed like debt, right? So what the taxation is up to 3 years, it taxes a marginal tax rate. Above 3 years, it is 20% with indexation. And when you add that indexation benefit, right, 20% with indexation boils down to tax less than 10%, right? Because of the indexation benefit that kicks in. So your net tax works out to about 8, 9, 10% in that range, right? Equities also today are taxed at 10%. Of course, beyond a certain capital gains, you end up paying 10% capital gains tax. Here also, after 3 years, it's about the same level. So if your horizon is 3 years and more, you are not adverse. It's almost a level playing field now. So, so when you look at a multi-asset fund and a horizon is 3 years, don't think it's adversely working in your interest. It is almost as good as what your best equity taxation could be, right? So, so it is not adverse. That's a myth that most investors have. If your horizon is 3 years, you're good to go.
And lastly, Chirag, since the multi-asset fund is a fund of funds, is it expensive in terms of charges when compared to a normal equity or debt fund?
Yeah, so it is slightly expensive, but what you get with that is a ready-made asset allocation that we kind of give you, which is all research backed. So we do not charge any management fee for the quantum multi-asset fund. We only charge the scheme running expenses, which is 0.1% only. So what you end up paying for a multi-asset fund today, including of the underlying funds, is around 0.5 to 0.6% in that range. Depending on the allocation, it may move up and down. But currently, if you see the based on current allocation, you end up paying around 0.5 to 0.6% as the expense ratio. So I don't think that's significant higher given what you get in terms of a higher return than your fixed deposits at most times. And at the same time, you get a ready-made solution for your asset allocation needs. So, don't get under impression there is dual management fee that you end up paying. There is no management fee applied on the multi-asset fund. And overall, if you see as a package, the expense ratio is not that high.
And just to sort of jump in there, if I can, Ghazal and Chirag, it's not that you have to buy the multi-asset fund, as Chirag indicated. You can create your own solutions. There was a query up there that, all AMCs are the same, and what makes it's a level playing field, and the data is out there effectively saying, is Quantum a worse or a better AMC? I think Quantum is an extremely unique AMC. We build Quantum with one single and simple purpose: to ensure that we give investors sensible solutions. Now, we started with the long-term value fund because that's our background. We're value investors, and we've got a long-term track record for being value investors. So we started with that one product, and we built these little building blocks. Imagine you give your children little Lego sets, and you tell your Lego sets to build different things. And with that, you can build a house and build a castle and build what you want. That's what we've done. We are the only fund house that will tell you to buy a solution. That solution actually earns us less money than making you buy an equity fund. We make 2 or 3 times more revenue for every rupee that you put into an equity fund than you would put into a solution basket that's showing up here on the slide. You tell me how many fund houses are offering you a solution where they know they're going to earn less money from you. I don't know if any besides Quantum. They don't exist as far as I know. They will sell you their equity product because that's like the easy thing to sell. Stock markets are going up, buy this now. In a bull market, it's easy to sell stuff. What we're trying to do is to ensure that you have a sensible long-term opportunity to earn returns to achieve the goals that you wish to in your life. Please, it's not a game where it's not like it's not a game to play. It's a means to an end, which is what I said before. And I think, yes, an AMC must have integrity and it must have competence. And hopefully we prove that across these solutions, we're giving you competence. There will be moments in time, and we've done webinars on this in detail to explain why the Quantum Long-Term Value Fund has not done well. And I'm happy to have another webinar. Subbu or Nilesh and Saul can have another webinar on that. Value is one style of investing. And and I'll tell you one very critical element of being a value investor. A value investor assumes that there's a cost of capital. There's an interest rate that you have to beat. When 80 to 90% of the world's bonds in the developed world are trading at negative interest, how do you become a value investor? You can't. It's like you're giving the bank 100 euros in Europe and you're going to get back 98 euros after 7 years, or 98.5 euros. You're paying the bank 1.5 euros to keep your money. So what will you do? You'll take that money and you'll start speculating. You'll help create an Airbnb. You'll help create, you'll take big wild bets. When you make big wild bets, value investing is helpless, because value investing assumes there is an alternative. There's a State Bank of India fixed rate. There's a Government of India bond rate, and you have to benchmark against that. But when your benchmark is negative interest rates, how do you become a value investor? You can't. So we struggled with that. And we have struggled with that. Is it possible that interest rates remain forever at these levels? Absolutely not. I would urge you to get on YouTube and look for Jeremy Grantham. He did an interview 7 days ago with Bloomberg. He's one of the best known value investors, and he'll give you a whole bunch of reasons why value investing has survived and will do well, and et cetera, et cetera. There will be cycles of a massive amount of pain, and we've seen that pain. Quantum Long-Term Equity Value Fund had terrible track record in 2018-19 kind of period for a little under 2 years, right? And we've done quite well, in the course of the last 8-9 months since the fall of the market. We've done well, and if a company like Reliance stumbles, we'll do even better because we don't own Reliance. So there are certain characteristics that 20% that you're seeing in the pie chart has, which is why we said, let's look out in the market. Who's managing a good small cap fund, a mid cap fund, and other styles of management, a growth equity fund, whatever. Let's put them into a basket of equity fund or funds. So when you're buying that circle, you're getting 8 fund managers. You're getting 8 different funds in that. 2 from Quantum, one run by Chirag, the India ESG Equity Fund, long-term value fund run by Saurabh and Nilesh. And then you're getting 6 other funds. And in that basket, you've got all the equity you need, and you'll do quite well from it. Right. So I think that's what distinguishes Quantum from the other AMCs, to answer the question that was out there.
Thank you, Ajit. Chirag, one more question coming in on the multi-asset fund. The smaller size of the multi-asset fund, can it create problems for the investor at the time of redemption?
The smaller size does not create any problem. What we ensure is investments that we make on behalf of the multi-asset fund are very, very liquid. So if you look at what we invest in is a long-term equity value fund, which is a much larger size and has a liquidity criteria inbuilt in the fund selection. We invest in the ESG fund for equity, which is also has a liquidity criteria for all its investment. We invest in the Nifty ETF, which is also a very, very liquid instrument, given Nifty is very, very liquid. For debt, we have the Dynamic Bond Fund, which invests in government securities largely. We invest in the liquid fund. So debt products are also very, very liquid. And we invest in gold, which is also very, very liquid. So all the underlying investments are very, very liquid. And therefore, getting in and out into any investment for any size is not a problem for us. Right? Long-term equity fund has a size of about $5-6 billion, which is about 35,000 crores. So that's not an issue. Each fund or each fund that Quantum Multi-Asset Fund invests into has a very big capacity. And therefore, there will be no issues for us to invest or redeem any amount that we want. So smaller size is not at all an issue. We can replicate the asset allocation strategy that we have with ease, and any inflows or outflows that we get, we can easily manage given the underlyings are very, very liquid.
So if I could just sort of jump in there, for every product that we've launched, we know the capacity of that product. So let's say you're Bajaj Auto and you're making two-wheelers in a factory, and you as an investor, you as the buyer of the two-wheeler, want to ensure that the first scooter that comes out on the Monday has the same quality as the last scooter that comes out on a Friday. That you should not worry which scooter you're buying, whether the first one or the last one or the one in between. You want to make sure they all have two wheels, they all have brakes, they all have clutches, and they all work well in a very, very similar way. So therefore, Bajaj Auto has a capacity for its factory. ACC has a capacity for its cement, etc. We have a capacity for each of our funds. And I know that the Quantum India ESG Equity Fund, which today may have 25 or 30 crores in it, has a capacity, what, Chirag, of
$3 billion. So 21,000
$3 billion.
crores.
If you want, you can go and collect all the money in India, bring us $3 billion to 20,000 crores. We'll give you the same portfolio, right? So it's that liquid. When we buy a stock, we look at the capacity. How big can this fund be? How large can it grow? And therefore, what is the liquidity? We have rules on liquidity for these products, which we have out there. So please do not worry about this small fund size. It really doesn't make a difference at all. The expense ratio is capped. You know what the total expense ratio is, right? So that is a given. You're not going to be paying more because it's a small fund, etc. So I don't think you should worry about capacity as such, in the discussions that I've seen.
Yeah, just to add that, larger fund size can be a problem, not a smaller fund size, because the larger the fund size gets and it crosses a certain threshold, it becomes difficult for the fund manager to replicate the fund easily and manage the inflows and outflows in the same way that he used to do before. And therefore, you should be cautious on fund sizes. Like many of the mid-cap funds out there are significant larger in size than what their capacities should be, right? And therefore, you should be cautious of those kind of funds. Smaller fund size are usually not a problem. And one thing that can assure you, if the underlying that the fund owns are liquid, then it is not going to be a problem at all. So that is what we
And
ensure.
just yeah, and just to add, a few years ago, I wrote an article in the Honest Truth where I looked at these mid cap, small cap funds, and I looked at the top 10 stocks of one of the very popular mid cap funds had, and and I showed in that article that if that mid cap fund had a redemption, it would take something like 200 days to sell some of its top holdings. 200 trading days, that's nearly 1 year of entire, there's about 220 days in a year to trade in the market. So to take nearly a year to sell some of its top holdings that are more liquid to pay off redemptions, and we've seen in a COVID style situation, we saw what happened with the Franklin debt funds and some other debt funds when debt funds were taking illiquid risks to some extent or illiquidity risks, and they could not, redeem money very quickly or sell their assets very quickly to pay off investors. So these are all risks that are there in the portfolio construction process that Quantum has tried to minimize, has tried to address. And, they're not up there anywhere. They're not, you don't see them in the fact sheets, but we've been very careful about this sort of stuff. And, again, there's a lot of questions about the long-term equity fund, et cetera, et cetera. Again, it's part of a basket. Please do not think of it as just the only fund to buy. Ajit Dayal is a value fund manager. He loves value funds. So my allocation may not be what you're seeing in the circle. I'm happy with lower returns for a period of time because I understand value more than I understand small cap or mid cap. But for a investor who's not involved in markets on a day-to-day basis, just look at the circles we build, look at the solutions we build, and use your Lego building blocks and make a wonderful little castle for yourselves. Back to you, Ghazals.
Chirag, next question for you. Given that the US dollar is being printed at an unprecedented scale, do you foresee the USD losing its status as the universal currency or losing its credibility? And what kind of impact will that have on gold?
Yeah, truly, the US dollar is under a certain kind of threat given the policies that they have been running. They have been running fiscal deficits even in the good years. For next 10 years, they're likely to have a fiscal deficit of more than $1 trillion. So overall, the policies that they have, an unprecedented amount of printing of money by the central bank, interest rates at zero level, I think they have kind of hit the roadblock in some sense. So given the policies that they're running, it looks like that the dollar should weaken going forward. And if the dollar weakens, it's going to be better for gold. So given that there is truly no big currency currently that can occupy the place that US dollar enjoys as a reserve currency, it's kind of staying afloat. If there was an alternative, I think there would have been significant amount of money being already moved out of US dollar. So currently it's enjoying the status because there is no real very good alternative. And given that there is a lack of alternative before some sort of transition happens, gold will be the beneficiary. So overall, I think the weaker dollar, which is likely given the policies, will help the gold going forward.
So if I can just sort of jump in there, because I know that there have been questions on Bitcoin. So, we know dollar is not going to be the standard. So Chirag and I don't believe that Bitcoin is going to replace the US dollar. So, Bitcoin is a very strange phenomenon. And, so imagine, and I've said this before, imagine you have things lying in a bank locker, right? So you have some gold or some rupee or silver or jewelry lying in a bank locker. What do? You have a key to the locker, you go to the bank branch, the bank manager takes you down the staircase, puts on the light, switches on the light. He has a key, he turns one key, you turn the other key, the door opens and your gold is there, your jewelry is there, your money is there, something is there. Now, Bitcoin is, you have a key, someone else confirms that you indeed have that key. So you both open the locker, and what's inside there is Hawa. There's nothing there. It's a digital bit. There's nothing inside there. So you're buying faith. You're buying the faith that yes, that guy's got a Bitcoin, I got a Bitcoin, and I can transact with him or her with Bitcoin. That's fine. So gold is also faith, right? Excepting gold has been faith for like hundreds of years, for thousands of years. People have had faith in gold. It may take some time for people to have faith in Bitcoin. You can't really touch a Bitcoin. You can't really feel a Bitcoin. You can lose Bitcoins. I mean, I know you saw that article that about 20% of all Bitcoins ever mined have been lost because people forgot their passwords or they threw out their computers. You may have read about that guy who's paying $7 million to go to a garbage field and to figure out where his hard disk drive is, because he's got hundreds of millions of dollars worth of Bitcoin lying in some garbage field where he threw out his hard disk. Now, you know, with gold, you don't have that problem, right? So I don't think Bitcoin is going to replace gold in a hurry. I personally, I nearly bought some Bitcoin in March for fun. I should have. I would have made a lot of money, but I got too nervous and I did not. But you know, in March of 2020. But you know, I don't see Bitcoin as something which will replace gold, as something which will replace the dollar. It's something which is fun. And I think for something from fun to be sensible and be taken as a standard of exchange, as a medium of exchange, will take a long, long way. And whether that's Bitcoin, but yes, if the Swiss government came out with a digital currency, with a cryptocurrency, or the US government, or the Chinese government, or the Indian government, there's someone behind it. That I can understand replacing, you know, paper currencies because there's a government behind it. Bitcoin, we don't know who's behind it. They still don't know who created Bitcoin. So I don't know. I don't see Bitcoin as anything serious in my view. Thanks.
Chirag,
Just to add on that, I think it's more of a greater fool theory out there. There is a lot of speculation on Bitcoins, and that's what's driving. Can it go higher? It probably can. Speculation can exist in a world where interest rates are so low, right? So, and you think of it, most of the governments are trying their version of Bitcoins, right? Or their version of cryptocurrencies. Will they allow an alternative cryptocurrency to stay when they have their own cryptocurrency? It's unlikely. So there could be curbs on the version of Bitcoins that operate. There are various other things that go around in terms of illegal activities surrounding Bitcoins. So there can be curves that come. So it is more speculative in nature. You need to be aware of the risk that can come along with it when there are government's own versions of cryptocurrencies coming. So be a little cautious on that side. It looks to me more of speculation.
Thanks, Chirag. Ajit, the next question is for you. What will be the most likely impact of the staggering level of debt and deglobalization combined together?
That's a big question. It will be staggering for sure. It will be. So, you know, the unwinding of debt by governments printed around the world, you know, even pre-COVID, but particularly after COVID, is the massive unknown. And that's why having gold in the portfolio is extremely important. No one knows when this is going to self-correct, but it's not going to be pretty. It's going to be very hard because what's really happened is the pain of economic breakdown because of COVID has been postponed to some extent. So whenever there's a crisis, the world has taken the pain and then you've recovered from that pain. That's a natural cycle of evolution. What's happened since the 1990s through Alan Greenspan's put, the Fed put, is that whenever there's a crisis, the Fed and now central banks in the world, including Europe, have said, hey, we'll just print money and sign you checks. So no one's ever really felt the pain. They've kind of kicked the can down the road, as the saying goes. And at some point in time, no one's going to, I mean, you know, after interest rates go to zero and they go negative, what happens after that? What do? You can't make a truck move by taking a string and pushing a string onto a truck. It's not going to move, right? So you have to make the truck move by starting the engine. The engine is economic activity. And sometimes the engine dies and the battery dies and you change it. We haven't let engines die. We've not let the batteries die. We've been out there trying to make sure batteries never die, engines never die, and everyone is fine. So I think that the pain in the world will come. It is definitely going to come, which is why having money in your savings bank account, having money in a liquid fund, which does not invest in private sector credit, etc., but only in government paper, is extremely important. It will come. And when that comes, the stock markets will come down because economic activity will decline. People's earning power will decline because the government will stop printing money and people will face reality. And that's when you'll have to dip into your reserves, you dip into your savings account, dip into your liquid fund to survive the calamity that will be there. Again, I don't know which year, I don't know which period, I don't know which decade, I don't know what will trigger it, but certainly this cannot go on forever. It may go on for 1 year, 3 years, 5 years, we have no clue. No one knows when. But please be careful. Do not assume that the world can only move on money. Eventually, it is earnings, and there's a question here on earnings. It is earnings that drive asset values. If you have a property, its its value is determined by the rent that you can get to some extent if you were to rent out that commercial space or that residential space. If you have a stock, its value is determined by the dividend or the earnings that will come out from that stock or from that mutual fund which owns the stock. If you have a factory, it'll depend upon the profits that can come from that factory. If you have a company, it's not going to come from the number of eyeballs or the number of customers that you have, but the amount of profit that you can make from the customers, from those people who come to your website or come to your AMC or whatever it may be that your business may be. So the reality will come in. And when that reality comes in, it'll be very, very ugly. And the way to take care of that ugliness is to ensure that you individually have saved enough money in different buckets. So even though your equity shares get wiped down by 30% or 40%, it does not matter for some time because you've got gold, which may go up. You've got the liquid fund, you have bank accounts that will allow you to maintain a certain lifestyle, even if you lose your job for some time. And, so I think you have to be very, very careful to not get caught up in these IMF forecasts and GDP forecasts and whatever else. There is a fundamental problem that there's too much money being printed in the world and too little output from that money, too little economic output. There's a mismatch. It will correct itself. It'll be a very severe correction whenever that correction does happen. So rather than forecasting it, be prepared for it and live your life every day, smile every day, and be happy and sleep well every night with a well-balanced portfolio.
Thanks, Ajit. Even though it is difficult to predict markets, our investors want to know your opinion on your expectations of equity returns over the next 1, 3, and 5 years.
Really? Okay. So I think India's in a wonderful spot that, as was shown by Chirag in some of the slides, if India plays its hand well, and I hope that on Monday we read the announcement of a good bank, I believe India could have a breakthrough GDP. In the GDP charts that Chirag had shown from 15 to 20 years ago, India's GDP has been declining consistently. It's come down to pretty low levels. So forget COVID, even before COVID was a slipping. One way to get India back to an 8, 9, 10% rate of growth is to take in $100 billion at, say, a 2% dollar rate of interest. A 2% dollar rate of interest is a rich rate of interest in the world today because, as I mentioned, interest rates are mostly negative. So if you took $100 billion at a 2% rate of interest in dollar terms, and you, the government, created this wonderful entity and said, you know what, anyone who wants to buy, who wants to borrow money for buying a home, come and talk to me. And of course, you cut the stamp duty down, as Chirag indicated, you keep property prices a bit low. So people are encouraged to buy. That 100 billion could be scaled up to 500 billion. So that 100 billion could be scaled up to 500 billion of economic activity, which will have its own multiplier. Because if you're a bank, you keep something in reserve and then you can create more money over that. That's how banking works. That's how lending works. So with a 20% margin, say, so you can multiply by 5 times. If there's $500 billion of money sloshing around in the economy, not trying to rescue the banks who've got NPAs and then the industrial houses who are fighting over those assets and trying to figure out who's going to make a higher bid, who can work the system and who can make money, but creating new wealth in the sense that individuals want to buy homes. There's a lot of housing stock available. Prices come down, stamp duty comes down, they go and buy those homes. And that buying of the home clears the stock. And then the developer has new money, new cash flow to buy new land and build a new set of homes. And that creates job employment. That, you know, in the last cycle of 2005, 6, 7, 8, when we had the brick bubble, real estate accounted for between 10 to 15% of GDP and economic activity and employment. And someone asked a question about employment earlier on. So employment levels in India are pathetic right now. We need to create more employment. And that can only come from economic activity, not necessarily from buying and selling NPAs or banks. There won't be much job opportunities in that, but there will be a lot of job opportunities if a new bank is created and if new money flows in and you get the real estate market kicking. That will add, if you think about the number 500 billion, and we are a 3 trillion, $2.5 trillion economy. That's a 20% addition to economic activity, say, spread over 3 years, spread over 4 years, spread over 5 years. So you can add 3, 4, 5% to GDP just by getting a good bank to give loans for real estate homes. So if that was to happen, I'm extremely optimistic on India. Being a value manager, I would still be optimistic on India. I'd expect earnings to go up dramatically and therefore the market to go up dramatically from where we are. So if you see that, you know that we're very bullish on India. If you see some silly tinkering of a bad bank and all, that means we haven't understood the problem and we certainly are not grabbing the opportunity. And that's been the problem with our policymakers. They don't get a sense of the opportunity out there. And to me, with interest rates low in the world and the rupee strong as we are today, we can actually make this work. And people are hungry. Chirag showed the data on the global pension funds, $32 trillion out there ready to deploy. They need earnings and they'd be happy with a 5-6% rate of return in rupee terms. You take a 2-3% knock on the dollar, they still are earning 2-3% in US dollar terms or in hard currency terms. They'd be very happy with that in this environment, for giving money to India. So based on that, where's the market going to be? Well, if the world is happy and money flows keep on, sure, the index will keep on hitting new records. If the world corrects, as I would expect it to correct, in terms of printing stopping and the economic revival not as good as people expected, so the economy shrinking, then as the world sinks, India has a chance to shine or India may sink with the world. You tell me policy, I'll tell you the index. Let me put the ball back in your court.
Thank you, Ajit. Chirag, coming to you, with such an uncertain economic climate and volatile markets, what is the asset allocation you recommend for a moderate risk profile investor?
So I'll tell you where we are coming from as given our allocations in the quantum multi-asset fund. Given that we are trying to reduce risk where we don't see it in the interest of investors. So in that fund, we are at around 26-27% allocation to equities at this point in time, which is a at the fag end of our allocation to equities, which is 25 to 65% range. So given that markets are expensive, we have seen some correction over the last few days. So if market comes to some sensible level from a valuation perspective, we will add to equities if there is an opportunity. So from a moderate investor, I think it could be closer to this or slightly higher than that, given the way valuations are. And if you see some correction, you could increase your allocation to equities. So for a moderate investor, it could be somewhere around say 30 to 40% in that range, not higher than that.
Sure. Chirag,
sorry, Gaza, can I just go back because there's a query based on what I said about real estate. I'm not advocating loans to developers. I'm actually saying you should not allow developers to roll over their loans. Therefore, they'll drop property prices. So I just want to correct that impression that's been there on the chat group. I'm still stand by that. Do not give any loans to developers. These are loans to home buyers who will buy property that is stranded properties, which these developers have, and they should be forced to sell while the government also encourages this transaction by dropping stamp duty. So just to clarify that. Sorry.
sure. Chirag, what is your take on global equities for diversification purpose?
Yeah, so global equities from a diversification perspective do help you, because one thing that we have seen over years, rupee keeps depreciating over last many years. If you see since 1970s till now, we have seen a gradual depreciation of the rupee by about 4 or 5% per annum, right? So we don't think that's changing significantly. We will see rupee depreciate going forward as well. There could be bouts of appreciation like we have seen previously, but gradually rupee is bound to depreciate, right? Given that rupee depreciation, you could add diversification from that rupee perspective. And two ways of doing that. One is international equities, and second is gold. To some extent, gold does fulfill that requirement. So unless you are convinced about certain equity markets, that long term it kind of adds value, you could look at that as a diversification. Like for example, the US market. Don't try to chase the FANG stocks. Today they are doing well, tomorrow they may not, right? So you could look at a broad diversified basket. Don't look at just a particular section of the market and which is doing well and therefore ride on that. Look at a diversified offering. You could do, but I would say that most of your diversification benefit that you need because of the rupee depreciation, you already get in gold. So don't get overboard with the fancy stuff going around with the demand, wanting an exposure to international equities. It's kind of being fulfilled by your allocation to gold. Don't go in a hurry. You could split that allocation into two things. One is some amount of international equity and more of that portion in gold. That will help you sail through.
Thanks, Chirag. Final question for the both of you. In fact, what are your assumptions, expectations from the upcoming budget? Chirag, you can go first.
Sure. Like Ajit said, some good policy, because it's an opportune time for the government to seize the opportunity. When global interest rates are so low and liquidity been sloshing around, much of that could be driven to Indian economy. Investors globally are in chase for yields. You could become, you could offer that with some sensible policy, so that it's a win-win for both. It's win-win for the Indian economy, win-win for those investors. And like Ajit explained, the real estate boom could be kickstarted by using that as an advantage and have policies and incentives designed for that to happen, right? So that is the the biggest wish list that I would have from the government, to have some policy that could incentivize starting things in the real economy. Like if you talk about either two big things, one is real estate, and one is helping the foreign companies relocate to India as they are kind of scrambling or redesigning their supply chains. That could some way come to India. Just the promise of Atmanirbhar won't work. You need real policies real incentives to be there to drive those investors. And one policy could be certainty in policy making, certainty in taxation that will bring those investors in the Indian markets. So that is one. Don't go just in terms of trying to collect taxes. That doesn't do good in the long run. Design policies, design incentives that kind of help Indian economy in the long run. So that's what I would say.
Ajit, your expectations, please.
You want me to go, Ghazal?
Yes, yes.
Yeah. So from my perspective, I've been disappointed by policy making of this government ever since demonetization. So I've given up in that sense. I think that there is a desire to do good that is clearly there. I don't know if they have a policy framework or a methodology to convert that desire into actual doing good. And, we've seen budgets now for a few years and they've been kind of insipid. This is important because we're coming out of COVID. And, it's extremely important. But I don't, I mean, I just say, let's wait and watch. I really don't have any expectations. I'll be delighted to be proved wrong and to be surprised on the upside. But, if I'd like to just talk a bit about ESG a bit, I think, Chirag kind of touched upon it when he spoke about supply chains being shifted to India. So that's part of the geopolitics in the world between the US and China and everything else. And so, so many global companies are going to look for supply chains around the world. But as they do, there's something which we don't read about much in the papers here in India, and which we don't discuss much, is that many of these multinationals are under tremendous pressure to ensure that whatever factories they build, whatever labor they hire, whatever investment they make, it'll adhere to standards of their home country. So there was a law, there was a there was actually a movement in Switzerland. They have a referendum. There was a movement in Switzerland which lost with a fairly narrowish margin, which was saying that Swiss laws would apply to Swiss companies no matter where in the world they were located. And that law, it failed, it did not go through. But that's the mentality now in Europe, in Canada, probably less in the US, but certainly in Europe and in Canada, where lot of the locals here are making sure that their parliaments are enacting laws which say that a country headquartered in this European Union must behave in India or Africa or Nigeria or wherever the same way that it is expected to behave in Europe. It must treat its staff well, must treat its labor well, it must treat the environment well, etc., etc. So in addition to thinking about how do you invite these multinationals into India to set up factory and kickstart our GDP and the capital investment cycle, you also have to worry a lot about how do you create the right policies which will encourage them to come. So for example, there was a change in labor laws, I believe in UP. Now that actually would frighten some of the European companies. It would not encourage them because they would say, well, so I remember Abraham Lincoln, I think it was, and this is again a quote from another philosopher, but Abraham Lincoln said many years ago, he said the difference between wage labor and slave labor is that in one, you have the option to go home when you wish to, in some sense. You may not get the salary, but you have the option to go home. And what people are looking for is more that German model, which we actually had in India till the 60s and 70s, where labor unions participated with management to build something. So if you look at Hindalco, if you look at, if you look at Tata Steel and look at Jamshedpur, so these were factories, and they built townships around these factories where the laborers were very well looked after. Hindalco and Hindalco and Tata Steel and many others. They built everything. They built the movie theater, they built the school, they had the temple, they had the church, they ran the water, they ran the municipality, they did everything, and everyone was happy. And then, of course, I think quantum is partly to blame for that, because we lobbied for foreign capital to come into India, and we did have that in the 1990s. We used to write a lot of articles in the 80s to open up India. And when we did, we started looking at quarterly earnings. And then companies had to become more efficient. And they became more efficient by shutting down the school for the labor, squeezing labor while the CEOs got rewarded more. And I think that whole mentality has to change, because there is a change in the world. There's a dramatic change in the world. And the more we recognize that, the more we accept that in our legislating, in our rule making, in our law making, the faster we'll attract foreign capital in terms of multinational job creation capital into India. And as you know, there's a lot of pressure on multinationals who are dealing with China because of what they're doing with the problem with Muslims in northern China and the concentration camps, which the Chinese are uh, calling training camps or whatever they call them. So there's a lot of pressure on companies to ensure that they are working in countries and in environments which is equivalent to their home countries. And so right from society, like I said, your internal labor to the external township where your factory is located, you have to treat them well. And I think that's a big thing, from my perspective, that we have to get that framework right. Um, Ghazal, is there any reason why you're ending early, or people are tired and fed up and everyone wants to eat some dinner?
No, Ajit, we've pretty much covered all the questions.
Okay.
I will be requesting both of you for your closing comments now.
So I would say that given that markets will keep moving, each asset will kind of have its own cycles in which it will move. But the importance of asset allocation is always advantageous to investors, even in any kind of market cycle like we saw in COVID, or like we saw in buoyant equity markets after that. Asset allocation has always helped deliver a sensible risk-adjusted return. So stick to your asset allocations, no matter, don't get carried away by some fancy form of investing like international equities currently, or like don't chase asset markets like most are doing currently with equity markets. Have an asset allocation approach, and I think that will help you in your investment journey.
Ajit, your closing comments, please.
Yeah, so mine would be kind of, follow the Prime Minister saying Atma Nirbhar, right? So look after yourself. And the best way to look after yourself is to ensure that you build a little moat, as Warren Buffett would say. You build a little moat around you, and you ensure that you have liquidity and safety in that. And then you have enough capital for you to grow for the future by keeping that in equity funds in the basket that we prepared for you all. Or if you feel this basket's not good enough, sure, you can obviously go around and see what other funds out there. But I think it's important to recognize that what happened in 2020 could happen every few years, right? As we invade, and as we interact with other species, because we knock off forests, we knock off trees, and as we kind of increasingly populate the world, zoonotics was a word that we hardly cared about prior to 2020. But, as animals have viruses, and as we interact with them, zoonotics says that a virus from an animal or another creature can come into a human. So, be prepared for that stuff. I mean, this is a wake up call for us to really be careful on many, many, many fronts. Not only on the money front, but that of course, as Chirag mentioned, having a diversified portfolio is extremely important. But I think it's a wake up call for us on many, many fronts. I have not hugged my children properly for a long, long, long time. I haven't hugged my members of my family for a very, very long time, my sister, brother, etc., for a very long period of time. So, you kind of realize how important those things are also, not just the asset allocation part, but even just, holding someone that you care for close to you for a quick hug or for a long hug, as the case may be. Yeah.
Thank you, Ajit. Thank you, Chirag. To our investors, we hope today's webinar has provided you with some valuable insights for positioning your portfolio in 2021. We also hope we've highlighted the importance of asset allocation and diversification and how the multi-asset fund of fund can be a good choice for the same. Though we have tried to cover as many questions as possible, if you still have any queries, please visit our website, www.quantumemc.com, and you can write to us or call our customer care and support team for further information. For those interested, the recording of this webinar will be posted on the official YouTube channel of Quantum Mutual Fund next week. Thank you all for tuning in. Again, a big thank you to Chirag and Ajit. Good night, everyone.
Thank you, Ghazal. Thanks, Chirag. Thank you, Ghazal. Thank you so much. Thanks, everyone. Thank you all for attending.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.